Hi all, welcome back to my channel Scapital Investments. My name is Salman Shaikh. So after finishing a successful series on futures trading, I have launched an option series, and in the part 1 I just taught the basics of options trading theory, and now we are going to cover the jargons in options trading. So let's decode the basic jargons in options trading. So in the previous video we understood the basic call option structure. The idea of the previous video was to capture the few essential call option concepts. It makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium, that is the agreement fees the buyer pays to the seller or the writer of the call option. So in this video of call options, we will attempt to understand the call option in a bit more detail. However, before we proceed further, let us decode a few basic option jargons. Discussing these jargons at this stage will not only strengthen our learning but will also make the forthcoming discussion in the options easier to comprehend. Here are a few jargons that we will look into. First is strike price, underlying price, exercising of an options contract, option expiry, option premium, and option settlement. Do remember, since we have only looked at the basic structure of a call option, I would encourage you to understand these jargons only with respect to the call option. So let us first understand the strike price. Consider the strike price as the anchor price at which two parties, that is the buyer and the seller, agree to enter into an options agreement. So in my previous video, I had explained the Ajay and Vinu example. In case you haven't seen that, please do check it out. So in the Ajay and Vinu example, the anchor price was 5 lakhs, which is also the strike price for their deal. We also looked into a stock example where the anchor price was rupees 75, which is also the strike price. For all call options, the strike price represents the price at which the stock can be bought on expiry day. For example, if the buyer is willing to buy ITC Limited's call option of rupees 350, 350 being the strike price, then it indicates that the buyer is willing to pay a premium today to buy the rights of buying ITC at the rupees 350 on expiry. Needless to say, he will buy ITC at rupees 350 only if ITC is trading above rupees 350. In fact, here is a snapshot from NSE's website where I have captured different strike prices of ITC and the associated premium. The table that you see is called an option chain, which basically lists all the different strike prices available for a contract along with premium for the same. Besides this information, the option chain has a lot more trading information such as open interest, volume, bid-ask quantity, etc. I would suggest you ignore all of it for now and concentrate only on the highlighted information. The highlight in maroon shows the price of the underlying in the spot. As we can see, at the time of this snapshot, ITC was trading at rupees 336.9 per share. The highlight in blue shows all the different strike prices that are available. As we can see, starting from rupees 260 with rupees 10 intervals, we have strike prices all the way up to rupees 480. Do remember, each strike price is independent of the other. One can enter into an options agreement at a specific strike price by paying the required premium. For example, one can enter into a 340 call option by paying a premium of rupees 4.75, highlighted in red. This entitles the buyer to buy ITC shares at the end of expiry at rupees 340. Of course, you now know under which circumstance it would make sense to buy ITC at 340 at the end of expiry. Underlying price. As we know, a derivative contract derives its value from an underlying asset. The underlying price is the price at which the underlying asset trades in the spot market. For example, in the ITC example that we just discussed, ITC was trading at rupees 336.9 in the spot market. This is underlying price for a call option the underlying price has to increase for the buyer of the call option to benefit. Exercising an options contract. Exercising of an option contract is the act of claiming your right to buy the options contract at the end of the expiry. If you ever hear the line exercise the option contract in the context of a call option, it simply means that one is claiming the right to buy the stock at the agreed price. Clearly, he or she would do it only if the stock is trading above the strike. Here is an important point to note. You can exercise the option only on the day of expiry and not any time before the expiry. Hence, assume within 15 days to expire, one buys ITC 340 call option. When ITC is trading at rupees 330 in the spot market, further assume after he buys the 340 call option, the stock price increases to 360 the very next day. Under such a scenario, the option buyer cannot ask for a settlement. He cannot exercise against the call option he holds. Settlement will happen only on the day of expiry based on the price the asset is trading in the spot market on the expiry day. Option expiry. Similar to a futures contract, options contract also has expiry. In fact, both equity futures and options contracts expire on the last Thursday of every month, although there are weekly expiries as well on every Thursday. Just like futures contracts, options contracts also have the concept of current month, mid-month and far month. This is the snapshot of the call option to buy Ashok Leyland Limited at the strike price of Rs 70 at Rs 3.10. As you can see, there are three expiry options. In stock options, even today there are only monthly expiries and not weekly expiries. Only in index options you have weekly expiries. So here, as you can see, there are three expiry options: 26th March 2015, 30th April 2015 and 28th May 2015. So at that point of time it was current month, mid month and far month. And of course the premium of the options changes as and when the expiry changes. We will talk more about it at an appropriate time, but at this stage I would want you to remember just two things with respect to expiry. Like futures, there are three expiry options and the premium is not the same across different expiries. Option premium. Since we have discussed premium on a couple instances, I guess you would now be clear about a few things with respect to the option premium. Premium is the money required to be paid by the option buyer to the option seller or writer. Against the payment of the premium, the option buyer buys the right to exercise his desire to buy or sell, in case of put options, the asset at the strike price upon expiry. If you have got this part clear till now, I guess we are on the right track. We will now proceed to understand a new perspective on premiums. Also, at this stage, I guess it is important to let you know that the whole of options theory hinges upon option premium. And option premiums play an extremely crucial role when it comes to trading options. Eventually, as we progress through this video series, you will see that the discussions will be centered heavily on the option premium. Now let us discuss this premium concept in the stock market perspective. So assume Infosys is trading at rupees 2200 today. The 2300 call option with a 1 month expiry is at rupees 20. Put yourself in the option writer's shoes. Would you enter into an agreement by accepting rupees 20 per share as premium? If you enter into this options agreement as a writer or a seller, you are giving the option buyer a right to buy the Infosys share at rupees 2300 1 month down the lane from now. Assume for the next 1 month there is no foreseeable corporate action which will trigger the share price of Infosys to go higher. Considering this, maybe you may accept the premium of rupees 20. However, what if there is a corporate event like quarterly results that tends to increase the stock price? Will the option seller still go ahead and accept the rupees 20 as a premium for the agreement? Clearly, it may not be worth to take the risk at rupees 20. Having said this, what if despite the scheduled corporate event, someone is willing to offer rupees 75 as a premium instead of rupees 20? I suppose 75 would make it worthwhile taking the risk. The point that I want to make here is that the premium is never at a fixed rate. It is sensitive to several factors. Some factor tends to increase the premium and some tend to decrease it. And in real markets, all these factors act simultaneously affecting the premium. To be precise, there are five factors similar to the news and time in real world that tends to affect the premium. So these are called option Greeks. We are too early to understand Greeks, but we'll understand the Greeks at much later stage. For now, I want you to remember and appreciate the following points with respect to the options premium. First is that the concept of premium is pivotal to the options theory. Second is that premium is never at a fixed rate and it is functional of many influencing factors. Third point here is that in real markets, premiums vary almost on a minute by minute basis. So if you have gathered and understood these points so far, I can assure that you are on the right path. Option settlement. Consider the call options agreement. So as highlighted in green, this is a call option to buy JP Associates at rupees 25. The expiry is 26th March 2015. The premium is rupees 1.35, highlighted in red, and market lot is 8,000 shares. Assume there are two traders, trader A and trader B. Trader A wants to buy this agreement option buyer and trader B wants to sell, that is write this agreement. Considering the contract is for 8,000 shares, here is how the cash flow would look like. Since the premium is rupees 1.35 per share, trader A is required to pay the total of rupees 8,000 into 1.35, that is 10,800 as premium amount to trader B. Now because trader B has received this premium from trader A, he is obligated to sell trader A 8,000 shares of JP Associates on 26th March 2015. If trader A decides to exercise his agreement, to help you understand this better, consider 26th March JP Associates trading at rupees 32. This means the option buyer trader A will exercise his right to buy 8,000 shares of JP Associates at 25. In other words, he is getting to buy JP Associates at 25 when the same is trading at 32 in the open market. Normally, this is how the cash flow should look like. On 26th, trader A exercises his right to buy 8,000 shares from trader B. The price at which the transaction will take place is pre-decided at 25, that is the strike price. Trader A pays rupees 2 lakhs, that is 8,000 into 25 to trader B. Against this payment, trader B releases 8,000 shares at rupees 25 to trader A, and trader A almost immediately sells these shares in the open market at rupees 32 per share and receives 2,56,000. So in case he sells the shares immediately in the open market, then he will receive the sum, and that is how the trader A will make the profit of rupees 56,000, that is 2,56,000 minus 2 lakhs on this transaction. If this was the same scenario in index options, then the trader B would give trader A 56,000 rupees. But of course, the option buyer had initially spent rupees 10,800 towards purchasing the right, hence his real profits would actually be 56,000 minus 10,800, that is 45,200. And in fact, if you look at it in percentage returns term, then it would be a whopping 419% without analyzing. So the fact that one can make such a large asymmetric return is what makes options an attractive instrument to trade. This is one of the reasons why options are massively popular with traders. So let me summarize the video for you. It makes sense to buy a call option only when one anticipates an increase in the price of an asset. The strike price is the anchor price at which both the option buyer and option writer enter into an agreement. The underlying price is simply spot price of the asset. Exercising an option contract is the act of claiming your right to buy the options contract at the end of the expiry. Similar to futures contract, options contract also have an expiry. Option contracts expire on the last Thursday of every month. Option contracts have different expiries: the current month, mid-month and far month contracts. Premiums are not fixed, in fact, they vary based on several factors that act upon it. So, the stock options I have for physical delivery in India according to the current rules, whereas the index options are cash settled.